Small and medium-sized businesses are the biggest drivers of the Australian economy, accounting for almost 50% of GDP. But they're not getting much of a go from the banks at the moment. In fact, getting money from the banks is a fraught and painful process for SMEs, and even if a business does get a loan, the rates are much higher than home loans. In a moment, we'll talk to one banker who believes it is a major crisis. But first, Neil Woolrich has a look at the problems small businesses are having with banks.
Peter Freeberg was a loyal ANZ customer for 30 years and even got a plaque to commemorate his long personal banking relationship.
Well, out of the blue one day, my old relationship manager came into work, and that's what the old managers do, they visit you. He presented me with this, which was fantastic.
But his business banking with ANZ soured when the bank sacked his long-standing relationship manager, then insisted on a type of loan that was unfavourable to PF Metal's export-driven business. After several fruitless discussions with ANZ, Peter Freeberg took his business banking elsewhere but kept the plaque.
Today it's actually used as a doorstop, but it's a very good doorstop because it's quite weighty.
However, for many small businesses, it's hard enough these days just to get finance, let alone shop around for a better deal. Plastics manufacturer Robert Wilson says the key is to have an open relationship with the bank.
In my case, we submit regular financial statements, but the managers come out here and talk to me and come and observe my business. Basically they're coming out to pick up the vibe of the business, if I can put it that way.
Palm Plastics had no trouble getting the funding it's needed through recent difficult conditions and has continued to invest in the business. But among the ranks of small businesses, discontent with banks is growing.
I think the big four are fair weather sailors. When the waters get rocky, you're in for all sorts of trouble, and my advice to any small business is to make sure that they're involved with two banks, not one, in a strong manner.
Look, I don't know anyone's out there that actually say that they're very happy with their bankers. Most of them out there, they're grumpy with them.
A study by banking analysts Eastern Partners shows small and medium enterprises, or SMEs, give banks an average rating of just over 4 points out of 10.
Pretty poor, it's probably putting it mildly. We have seen a continuing downward trend in terms of satisfaction overall towards their banks with the SME community.
And survey after survey shows SMEs are now struggling to grow because banks are cutting back their lending to the sector. That's partly through choice and partly because of the scarcity of funds. Local banks have had trouble getting money from wholesale funding markets, and foreign banks have made a hasty retreat from Australia.
In the last 3 years, due to all sorts of reasons, whether they've gone into receivership liquidation or the GFC has pulled them back from Europe or America. We've gone from a total number of 23 or 24 lenders down to a possible number of 7 lenders now.
Those banks that are left are choosing to lend more to large firms or against home loans, which are statistically the lowest risk. Financial advisor Michael Pratt says small businesses are having more trouble in getting loans now than they did in the recession of the early 1990s. And banks are also imposing more onerous terms, like requiring borrowers to sign a director's guarantee, which could put personal assets at risk.
I've got no particular concern with that. Business is risk, and you've got to learn to manage your risk. And I always say that the first rule of business is to remain in business, and a large part of that is to manage your financial risk.
In 2008, interest margins on small business loans jumped by 2.5 percentage points. While margins have come back slightly, small businesses are still paying much higher interest rates than big firms and homeowners.
If you've got $1 million or $2 million bill facility, and all of a sudden you had 1.5% margin 3 years ago, now you've got 3%, your annual costs have gone up by $50,000 or $60,000 or $70,000 a year, which is $6,000 a month.
And for those trying to roll over their loans, Michael Pratt says it can take 3 months to refinance.
It's a time with the accountants, it's time with the solicitors, it's cash flows, it's banking, and all that gets charged for. So it's not only the bank that's charging, it's also the solicitors, it's the accountants, because the bank want this figure, this figure, this figure. They want new cash flows. So the costs are obviously going to accelerate.
As a result, small businesses are still sticking with their banks, even when dissatisfaction levels are rising.
We have seen a reduced and certainly a perceived reduction in providers of banks and providers of debt facilities amongst SMEs. What we're seeing is that despite this, I guess, growing dam of dissatisfaction that we've got amongst SMEs, they're actually still remaining stickier.
Small businesses in Australia are also being affected by global banking regulations made far away in the Swiss town of Bâle. One of the key reforms requires banks to hold more capital against riskier loans. That's making it easier for Australian banks to lend to a homeowner than a factory. However, industry watchers argue that government efforts to stimulate small business lending are unlikely to succeed.
In places where there's perhaps more direct government intervention like the UK, even in those type of circumstances, there's only so much the government can do and perhaps are willing to do in terms of getting involved in pushing the banks into certain habits of lending.
That means small enterprises are learning to do more work with less bank funding.
We had 17 staff here 3 years ago, 2.5 years ago. We're back to 12 now, and we're probably turning over a similar amount of money.
And with Europe's debt problems still far from resolved, local businesses will have to get used to a long period of expensive and strictly rationed credit.